Have you ever heard of a fat finger trade? It's one of the most wild and, frankly, terrifying things in modern finance. We're going to talk about how one simple, human typo, like an extra zero or a misplaced letter, can unleash billions of dollars of pure chaos in literally the blink of an eye.
Now, this isn't some Hollywood movie plot. There's no criminal mastermind, no complex hacking scheme. Nope. This is all about a highly trained professional working under insane pressure who makes a mistake anyone could make. You know, the kind of slip-up you or I might make typing an email. Except in their world, once you hit enter, there is absolutely no undo button.
And this is what that mistake can look like. 300 billion euros. That was the size of a single order mistakenly sent to the market in a very real, very recent event. So how on earth does a simple typo turn into a number that looks like that? And what happens when a number that big actually hits the global market?
All right, so here's how we're going to break this whole crazy story down. First, we'll dive into the shocking Citibank case that inspired this. Then, we'll look at the anatomy of these errors. What are they, really? We'll see how they trigger a millisecond meltdown, and we'll explore the cracks in the system that allow this to happen. Then we'll look at the guardrails being built to stop it, and we'll wrap up with the big paradox, humans versus machines. Okay, so let's set the scene. It's May 2022. We're on a trading desk in London. A trader at Citigroup has a pretty big, but, a fairly routine job to do, sell a basket of stocks. But what happens next is anything but routine. The sheer simplicity of this mistake is what's so mind-boggling. The trader was supposed to sell 58 million euros worth of stock, a big trade, but totally normal. Instead, an order for 300 billion euros blasted into the system. Now, thankfully, their internal controls did catch it pretty fast, and only a fraction of it actually went through. But it was still enough to cause an 8% flash crash in the Swedish market, all because of one keystroke. Insane.
We've seen the chaos it can cause, so let's get down to brass tacks. What exactly is a fat finger trade, and what makes it so unbelievably dangerous?
So at its heart, it's just a human mistake. It's not a bug in the code. It's not someone trying to rig the markets. It's just a simple data entry screw-up. Somebody types the wrong number, hits the wrong key, and accidentally creates an order that is just astronomically larger than they ever intended.
Now, these errors usually come in two main flavors. The most common, and by far the most destructive, are quantity errors. You mean to sell 10,000 shares, but you accidentally type 1,000,000. That mistake just instantly vaporizes all the buyers in the market, causing the price to completely nosedive. The other kind are price errors, like misplacing a decimal. They can still cause a lot of havoc, but the quantity errors, those are the real market killers.
So you have to wonder, how do these mistakes even get through? Well, the truth is, the entire trading environment is basically a breeding ground for them. You've got traders under constant pressure to move lightning fast. The software they use is built for speed, not safety. There's often no "are you sure you want to place a billion-dollar order" pop-up? And once they hit go, the trade is done in milliseconds. That's way faster than a human brain can even process that a mistake was made. And that speed, that brings us to how fast this disaster unfolds. An error is made in a split second, but how does it ripple through the entire market so quickly? Well, it's a terrifying chain reaction that happens, literally faster than you can blink. It's this four-step domino effect. First, the gigantic order hits the market. Second, it immediately sucks up all the normal buyers and sellers. We call this a liquidity vacuum. There's just no one left to trade with at the normal price. Third, the high-frequency trading algorithms, the bots, see this sudden price drop, they assume it's real news, and they start selling like crazy, which just pours gasoline on the fire. And finally, that triggers other algorithms to start dumping related stocks and ETFs, and suddenly the panic spreads everywhere. And here's the absolute kicker. The entire process, from that first typo to a market-wide meltdown, can be over in just a few seconds. By the time a human risk manager even gets a flashing red alert on their screen, the damage is already done. The money's lost, it's over. And look, this is not a new problem. Not by a long shot. These kinds of events have been popping up for decades. From currency markets back in the 90s to the infamous Knight Capital disaster in 2012. That one was actually a software bug that acted like an automatic fat finger, and it cost the firm almost $500 million. The tech gets faster and faster, but that fundamental risk of a single, massive wrong order, it's still there.
So this just begs the question, right? In an age of supercomputers and AI, why do our incredibly advanced financial markets keep getting tripped up by such a simple human mistake? Well, the answer is kind of baked into the very design of modern trading.
It really boils down to three core issues. First, systems are built for what's called straight-through processing. It's a fancy way of saying once an order is in, it's executed automatically. No human checkpoints. It's all about speed. Second, yeah, there are risk limits, but they're often set super wide so they don't accidentally block legitimate, huge trades from big institutions. And third, like we talked about, the software itself is designed for raw velocity, not for safety.
Okay, so after decades of these things happening, what's actually being done about it? Well, regulators and exchanges have been busy building a whole series of digital guardrails and emergency brakes. They're designed to contain the damage when, not if, the next big error happens.
This is basically their multi-layered defense system. First up, you've got circuit breakers. If a stock's price suddenly tanks, trading just automatically stops for a few minutes. It's like a timeout to let everyone catch their breath. Second, firms have kill switches, so they can instantly shut down a desk or an algorithm that's gone rogue. And finally, as a last resort, the exchanges themselves have the power to just cancel trades that were obviously a mistake, basically hitting rewind on the whole mess.
And all of this leads us to this really fundamental conflict that's right at the heart of modern finance, our relentless, obsessive pursuit of speed versus the simple reality of human error.
This quote just hits the nail on the head. The system is built for one thing and one thing only, execution speed. It is not designed to pause and ask, hey, wait a second, did a human really mean to do this? Its only job is to do, instantly. And that total lack of skepticism is what turns a simple typo into a potential catastrophe.
So, where do we go from here? Well, the future is all about building a smarter, more adaptive digital immune system for the markets. We're talking about controls that can actually learn a trader's normal patterns and flag anything that looks out of place. We're talking about better interface design, with big, flashing, unmissable warnings. And ultimately, it means using AI to analyze orders in real time, to catch that statistically impossible trade before it ever gets out the door.
Which leads us with this one giant final question. In this constant race for microsecond advantages, we've built a global financial system that runs at the speed of light. The challenge now is to figure out how to give that system enough intelligence and common sense to protect it from the simple, inevitable mistakes of the humans who are still, for now at least, in the driver's seat.